Alright everyone, welcome. I've explained assets already. Now I'm going to explain equity or, net worth. Equity or net worth. Don't know why I forgot the word. I've said it a million times. Anyway, in between those two, I'm not going to make a video separately for this. I'm just going to explain it here because it doesn't need an entire video. Liabilities is a concept that is necessary for this. What is a liability? In terms of this and what I'm talking about, a liability is what you owe. The easiest way to explain what a liability is what you owe. For example, you own a house. You own a house, okay? But you have a mortgage. Your mortgage is your liability because you owe whatever it is. You buy a car and you get a loan. Your liability is the loan. You have a credit card, your liability is the credit card balance. You get my point. What is net worth then? So if your house is your asset and it's worth 500, whatever you want it to be, I'm just going to say 500. And you have your mortgage and it's 400. Let's put it here. This is worth 500, your house, your asset. Your mortgage is 400, so you owe 400, your liability. 500 minus 400 is 100. That is how you calculate owner's equity. Owner's equity, net worth. These are words, you see them all over. They're interchangeable, really. However, what does that mean? That means that should you sell your house at that given time, you'd get $100,000 back. Right? Because you're not going to get any more than what you owe. The bank's going to take their money. And that goes for anything. So, how can a liability work in your favor? Well, if you have a liability, why do we get liabilities? Well, businesses operate, thrive on it, in a sense. You need money, you need capital in a business to purchase an asset, right? So you can get that in two ways. Somebody invests, so they now get some equity from the company. Or you go into debt. You owe whatever company, other company, or whatever it is that's lending you money so you can buy an asset. And the intention when you buy an asset is that it will earn more money than you're paying in your liability. That's how, in the most basic sense, obviously. It's a lot more complicated. There's a lot of other things involved. But the gist is you want your asset to contribute to your earnings more than how much you're paying in your liability. It's not always direct like that. It's not that easy. Now, that was the strategy of net worth. The only thing I want to say finally is do not confuse net worth with income. What does that mean? Your net worth is what you have. At any given day, it's a picture. That's what you're worth. You take what you have, you minus what you owe. You take what you own, you minus what you owe. However you want to say it. Whatever's left, that's your net worth at that given second in time. Okay? Your income is something that's ideally, I don't know what I'm trying to say. Ideally, it's on an ongoing basis. Monthly, weekly, yearly, however you want to look at it. That's an income. Income usually has expenses that go with it, right? So if your income is $10,000, but your expenses are $10,000 a month, let's say. So $10,000 a month income, $10,000 expenses. Guess what? Your net worth, your leftover, your savings, however you want to say it, is zero. So you have nothing left to add to your net worth. So $10,000 a month is $120,000 a year. And we would say, oh, that's great, cool. And it is a great income, but if that person has so many, spends so much on things that are not assets, let's say, or saving their money is considered an asset too. Money that's in savings, cash, asset also. Investments, assets. So if that person has $120,000 income per year and they're spending $120,000 per year, they're actually not adding to their net worth in any way. So they're still netting, that's the word, netting, zero. On the counterpart, don't think that someone who has a crazy high net worth has a lot of income. This person, theoretically, could have penny pinched and scrounged and put all their money away and like built up like this fund of like $500,000, but they didn't live their life. They're penny pinching, and they could be making like $25,000 a year, but over so many years, their net worth in paper on whatever is $500,000. Like, I'm just saying, that goes to any level, really. Net worth is like you're taking the value of your assets and you're subtracting the liabilities, and that's the leftover net worth. Now, if that net worth is not generating a lot of income, then what good is it? You could sell it, yeah, but generally when you're liquidating, I'm not going to get into that anyway. I'm going to stop myself from getting into more tangents. But I hope the gist was, I'm just going to, one last time. Assets, what you own, minus liabilities, what you owe, so like a mortgage, for example, debt, etc., equals your equity or your net worth. Now you know some little things when you hear these words, what they mean, number one, and also maybe you can think about, I make X amount of money and I spend this much money, so what's my net worth at the end of a month? Or how much can I contribute to my net worth? So when you save money and put it into savings, you're increasing your net worth, for example. And that's that. If you own a home, take what you could sell your house for, so like an appraised value. Be conservative. Subtract your mortgage balance, like the remaining that you owe. The remaining, like the difference between those numbers is your net worth on the house, your equity. And that's all I have to say. Let's keep growing together. Please like, comment, and subscribe, and I'll see you guys next time.